Don't you
Evening,
love to hear
guys. How are we all doing?
recording in progress? I'm good. How are you boys?
Very good. Very good. And
Indeed.
you?
Yeah, good.
Indeed.
Thanks very much. As you can see, I'm sitting in the jungle. You're sort of sitting in the jungle, but
I have my usual.
Mine's
I
a
have my
real
usual sparkly
jungle.
background. This
Yeah,
is
what's
this is
yours, Andy?
this is real. This is the real sparkly background
Are you
because
in an egg?
no. So a long while ago, it's my daughter's dressing room, and she loved having this sparkly dressing room, and then she grew up and moved out. But I just like the sparkle of it. To be honest with you, I think it kind of adds a
I,
little vavavoom
I
to the
think
event,
really,
doesn't it?
Andy, it's your room all the time.
You think that's what it
It's
is?
nothing to do with me or whatsoever.
What do you think? I come in and like put on a Taylor Swift cowboy
Yeah,
hat
yeah, I
and
do.
play some
I do.
tunes just
I
on
think
my
you
own.
always have, whether it be Taylor Swift or any other band you've been in there. You said to Caroline, look, I think what I really need to do is have a sparkly wall somewhere.
Yeah, yeah. The day's been hard. I'm off to the glitter room.
Yeah. Has it got like a disco ball or
Yeah,
something?
I'm going to have a pina colada and I'm off to the glitter room.
Yeah.
I shall see you later.
I'll tell you what, at least after the budget yesterday, see what I'm going to do now. I didn't feel we had to run off to go and have a pina colada in a darkened room and take a few
No,
days. It wasn't,
no.
unless of course Seb is now going to tell me that I completely misread the budget.
No. That's the big takeaway. That's the big takeaway. It's not all doom and gloom.
Yeah, I must admit, I mean, I know you'll go through it, but I was quite sort of, I don't think the word pleasantly surprised when it's going to cost us all money, but surprised at what they did and what they didn't do, really. It was all, it was almost, it makes you wonder, doesn't it, really? Were they so clever that they basically sowed the seeds of terribleness? So therefore, suddenly, and it was only really last week, wasn't it? They sort of introduced the concept of the NI thing.
Yeah,
and I thought it was either really cleverly managed.
I think we were mentioning before, it's political spin at its finest. You know, put everything out there that could be bad, and then what actually turns up won't seem as bad as everything.
Yeah, everyone's going, oh yeah, that's all right then.
Absolutely, I was going to say it's mastery and kind of making people accept whatever they put in front of them isn't actually that bad. So it wasn't too bad. Yet I'm not going through all the details.
I think it's made me want to drink draft beer.
Yeah, there's a big section on that. Lots of laughs in the comments.
We should all be setting up microbreweries. Right, what we'll do is we've got a decent number of people turn up. So I think we'll get the introductions done. We'll then get the meat on the bones, and then we'll get some questions and answers. So welcome everybody that's joined us. You obviously know why you're here. This is our review of the budget that took place yesterday, which is going to be good. We're joined by Seb Stracey. Seb's an associate at Humphrey & Co, one of the largest dental specialist accountants in the country. Seb acts for a range of dental clients from FDs, associates, through to mini corporates and practice owners, with a particular interest in helping achieve tax-efficient acquisitions and eventual sales of dental practices alongside annual compliance and the year-to-year advice that everybody needs.
And a nice chap.
Absolutely nice chap. Absolutely nice chap. And we've also got Adam Brookbanks joining us. Adam's the Managing Director of FTA Wealth, holds a diploma for financial advisor and has been awarded professional status by the London Institute of Financial Services. Adam, we've worked with Adam for many years. He's a great independent financial advisor, works with our clients and looks after us. I think his greatest skill, he takes a very holistic approach to business, specialising in investments, pension planning, and tax efficient strategies. So what we're going to do is we're going to kick off with Seb, kind of doing the review of what he saw in the budget, and then he'll pass over to Adam, and Adam will talk about what that looks like in terms of how it will affect you in terms of pension provision, investment planning, and things you can do to try and mitigate some of those increased costs that are going to be coming through. So I'll hand over to you first, Seb, and then on to Adam. If you have any questions as we go through, the Q&A is open, so feel free to drop them in there, and then we'll have about 10 minutes at the end for Q&A.
Yeah, so it's up to 8. We're again aiming for 8, aren't we? We're going to disappear and mute.
We'll mute ourselves and
we're not distracting for everybody.
Exactly. So yeah, over to you, Seb.
Great, thanks both. Good evening, everyone. Thank you for attending. Like we've kind of already a little bit of preamble towards, we'll talk about the budget and actually how things aren't quite as bad as what we maybe thought they were. Go through a bit of the detail, because the devil is always in the detail on these things. You always see the headlines, but actually there's a lot more going on behind the scenes. So we're going to run through all of that and actually the impact on dental businesses and kind of the dental focus side of that. So it's going to be a lot of facts and a little bit of discursive stuff. But as already mentioned, any questions, just keep popping them away. More than happy to answer things toward the end. time permitting. So a bit about myself. So my name's Seb from Humphrey & Co. We are a firm of dental specialist accountants. This is basically all I do, talking to dentists day in, day out. So there's not a lot we haven't seen. So puts us in a good position to know how the budget is going to affect practices on a day-to-day basis, particularly with a view for those looking at selling or the other side of the spectrum, those buying. So a bit about myself. My email address is up on the screen. So it's Seb Stracey, not Seb Stacey, as I've accidentally put in my Zoom profile, but it's Seb Stracey. More than happy to field any questions by email if there's something you want to ask which is a bit more specific and personal to you, which we don't have time to maybe squeeze in this evening. So without further ado, we're just going to kick off and start by looking at the business policies, so the things which were put in place for businesses at the budget yesterday. The first one is undoubtedly good news. Corporation tax has been capped at 25% until 2030. So that is an extension of the cap. So that cap was originally in place for a few years earlier and it has just been extended. Now, I say this is good news. Obviously, from a few years ago, that's much higher than what it was. But the last government did put it up on this ratchet system. And I think the expectation was at some point Labour might put that up. Corporation tax has historically been higher than this under Labour governments, so the expectation is that was potentially an area that could have been attacked. So it's actually good news to see this has been capped all the way up until 2030. This does give a degree of certainty. So for those looking at buying practices and those running practices already at the moment, this is a degree of certainty that actually that staying at 25% isn't the worst thing in the world. So it gives a bit of stability on the corporate tax side of things. Likewise, again, this has been a bit of a running theme, and I'll comment on this in a moment. So R&D incentives, annual investment allowance, and the full expensing that was introduced by the last government have all been maintained. Nothing's been scrapped on that front. So this is really looking at capital expenditure within practices and the relief that's given for corporate purposes. They have all been maintained, so you can still get large write-offs for buying equipment, provided they meet the various qualifying conditions. The theme really here is that there's no big giveaways. So I think what we've been used to for the last 14 years is in a budget, there's often a bit of bad news, a few changes, a few rises, and sometimes it's referred to as maybe a rabbit out of the hat or a bit of a giveaway that's usually balanced with some sort of incentive, some new incentive that's good, a bit of a giveaway, a bit of a boost. There wasn't really much of that yesterday, but what we do have instead is rather than extreme measures, and then some giveaways as well to balance it out. We've seen this really sort of balanced approach where things have been put up, and we'll comment on things that have gone up in a minute, but maybe not to the extent we thought. But the balancing side of that is things that we thought could have gone up, that were sort of almost ripe for the taking, shall we say, have actually kind of stayed the same. So it's that balanced approach. There's no big giveaways, but things like corporation tax and R&D, AIA, and full expensing, them staying in place as they are is kind of as close to a giveaway as we get, and that is good news ultimately. So we could have seen those gone up. There were rumours, particularly about corporation tax, at some point going up. So the fact that's locked in for such a long period of time, as I said, it's only good news. But this was the big hit, really. This was the headline. This was the money grab. This was the £22 billion raiser. Employers' national insurance has increased from 13.8% to 15% from April 2025. This is quite a big deal. While only 1.2% it is quite a big chunk. It is going to affect a huge number of businesses. It makes it's hard to put any sort of silver lining on this element of it, other than that it's only going to affect those that have employees. So for most dental practices, obviously your associates are going to be self-employed, so you are only looking at nursing staff, reception staff, etc. But it is still a tough pill to swallow, because this is where they've really gone for raising taxes. This is where they're getting most of their increased revenue from. So the increase of that is going to affect most people and does need to be thought about. The threshold, again, this is the double whammy effect as well, because they then reduced the threshold when employers will start paying national insurance. It used to be above £9,100, and that's now been reduced to £5,000. So employers are going to start paying an increased rate even earlier, which means the bills are just going to be much, much higher than they were before. So the 1.2% by itself isn't horrific, but the fact that it kicks in £4,100 earlier does start to build up and can basically, the numbers you'll see total around how much it's going to cost per employee extra per year. It's hard to swallow, thinking where's that going to come from? Is it going to come from profits or stagnating wages? But again, this is that balanced approach they've gone for. They have increased the employment allowance. So for dental practices, to put this into some context, if you are a predominantly private practice, you'll be entitled to the employment allowance, which is basically £5,000. You don't have to pay. You don't have to pay the first £5,000 of your employer's national insurance. That's now been increased to 10,500, so quite a hefty jump. And in certain situations, I haven't crunched all the numbers to give all the scenarios, but in certain situations, the combination of those three factors, the increased rate, the reduced threshold, but then the increased allowance, you may get some businesses which actually are ever so slightly maybe better off, because the first £10,500, even though it's gone up, if they're not paying that, they're not paying it. It doesn't matter that it's gone up, because ultimately then it's not coming out of their pockets. But for a lot of businesses, it will mean increased national insurance bills. And particularly in the dental context, if you're an NHS practice, or more than 50% of your income is generated through the NHS, then you're not entitled to the employment allowance. So that going up doesn't give any sort of balancing effect. So that's the only real, this is sort of I'd say the big negative. As I said, there's a lot of positives to take out of this, and I will cover it, but this is the one where the taxes are hit a little bit hard. But again, within the dental market, it's fairly narrow. It's not, you aren't reliant on 40, 50 employees per practice. It's not a hugely or employee intensive operation, so it shouldn't hit too many dental practices too hard. Yes, it will be slightly more, but it's not the worst thing in the world. So that's all for businesses, really. So businesses actually got away with things relatively easy. Only employers' national insurance was gone after. It also wasn't gone after to the extent we maybe expected. Again, we sort of joked about this at the start, various leaks of what there might be. There was talks of a 2% increase. There were talks of putting employers' national insurance on pension contributions. None of that materialised. So actually, if I go back a slide, what we do have and the effect on businesses isn't that bad. We've got a couple of positive points and one sort of negative point if you look at it that way, giving a fairly balanced approach. And ultimately, I think that's just going to give people confidence that it isn't an anti-business budget. Yes, they're trying to raise a bit more revenue. Some businesses will be affected, but they are still giving some relief to those smaller businesses without that many employees. On the individual side of things, there were a few more announcements which I'll go through in a little bit of detail. The first one is capital gains tax. So this was lots and lots of rumours, lots of leaks, lots of talk about what could happen with this. You might have seen people talking about the intention to align it with income tax rates. So as a reminder, capital gains tax rates for non-residential property was 10 and 20%, very low. And there were talks aligning that with income tax, so 20 and 40%. And that would have been, wouldn't go say disastrous, because again, you're looking in the context of historic capital gains rates, that wouldn't be crazy high, but it would still be very, very high. And actually, we did get some increases, and they weren't quite as bad as what we were anticipating. So again, it goes back to this theme of not really giving too much away, not many giveaways, not too many additional incentives or allowances or threshold increase or anything like that. But equally, the bad stuff, the stuff we were expecting, hasn't materialised. It ends up being quite a balanced approach, a sensible approach, incremental increases, which shouldn't affect people too much. They will obviously affect people. I'm not going to put too much of a spin on this, saying that it's business as normal. There are additional taxes that need to be saved for, but it's all within the realms of growth. If you've got your dental practice growing quickly enough and in the right way, they're going to far outweigh the incremental increase in taxes that we've seen. But yeah, capital gains is a big one. So if you are thinking of selling your practice, this will affect you. Ordinarily, I think when this was announced yesterday by Rachel Reeves, I was sort of writing away and furiously trying to read the supporting paperwork that goes with this, and assumed that this would have kicked in from April 2025. But these rate increases are effective as of today or as of yesterday. So there is really no room for manoeuvre. They are what they are. But again, like I said, we were expecting much, much bigger increases, and they're not wholesale too much higher than what they were before. So the lower rates increased to 18%. But again, most practices, when you're selling, you're really not going to pay anything there. That's only for sort of year to year capital gains. So those people are supposed to do investments, etc., and maybe just sell a small amount each year to make use of their allowances. But if you are selling a practice, it's really just this 24% rate that's going to affect you, which is only a 4% increase on what it was before. Yeah, that applies to you. We will talk about business asset disposal relief in a minute, which is maybe a bit more relevant. But if you don't qualify for business asset disposal relief and you're selling a practice, it's only a 4% increase. When you crunch the numbers, For every £1 million of gain, that's an additional £40,000 of tax, which again, when you look at it in that context, isn't going to change retirement plans, isn't going to change things dramatically. It's raising revenue for the government, but it's not suddenly going to take deals off the table. It's still a good time to be thinking of selling. Capital gains rates are still relatively low. Again, you've got to always look at this in context. It's like with the interest rates when you go back a few years ago, interest rates super low, and then when they go up even a little bit, even to rates that are still much lower than the history, you go, oh, this is really bad. But actually, in the context, in the grand scheme of things, in the grand scheme of planning, when we talk about planning, you're always looking at long term. These increases are pretty tolerable. So if you're thinking of selling, I don't expect this is going to have scared off buyers. It should be scaling off sellers. These are small increases. Again, compared to the 40% we'd heard about before, 24% is a good result. And residential property rates remain the same. So just a reminder, those are 18 and 24%. So they are aligned in that respect. And again, kind of keep mentioning this, that is the theme throughout. Yes, no big giveaways, but that remaining the same, not hammering landlords. For a lot of dentists out there will have buy-to-let portfolios, not hammering them even further than what's happened in the last 14 years is still a good result. So those residential property rates remaining where they were, that's good news. And business asset disposal relief, or entrepreneurs relief, as most of us still call it. Just a bit of a reminder about what this is. So this is when you sell business assets or shares in a business, provided you meet certain criteria. I won't go into the criteria now, but provided it's basically your business, you've owned it for at least a few years, and you own the majority of it, then you're going to benefit from business asset disposal relief, where you pay 10%, or previously you paid 10% on qualifying gains, and that's on the first £1 million of gain across your lifetime. This is something that every single budget I've come across, there's always been talk that it's going to be abolished or changed. If we went back 5 or 6 years, this limit was £10 million. We got told it was going to get slashed. So people suddenly started panicking, trying to dispose of things before the next budget, and then it got reduced to £1 million, which in the context of a lot of dental practices, we're talking about gains here, not proceeds. £1 million for a lot of dental practices will cover most of that gain. The fact that's been retained, again, lots of rumours the last few weeks, there were rumours this was going to be abolished entirely. The fact it's been retained at £1 million is nothing but good news. As I said, this is the one thing that has consistently come up in virtually every budget I've covered, saying that it's going to be abolished, it's going to be taken away, and actually it's always stayed there, just with minor tweaks. And we've got some tweaks this time around. So again, it's this balanced approach of taking a little bit of something without going too far, without really trying to destroy the market. I think the Chancellor has learned from previous mini budgets where if you scare the markets too much, it doesn't bode well for your political career. This time round, they've taken a softly approach, incremental increases, not going too far, not pushing too hard. And it's the same here with business asset disposal relief. So where it was 10% on qualifying gains, from April 2025, that is going to be 14%. So again, just the maths on that's a 4% increase. That's only £40,000 on every £1 million worth of gain that's increasing by, and then 18% from April 2026. So just under a couple of years' time. So again, that's £80,000 on every £1 million. Now, ultimately, if you're thinking of selling and planning a sale, and you're looking ahead to 2 years, you think actually I'm not going to sell tomorrow. I'm going to be selling in the next 2 to 3 years. Rates are going up. What should I do? Ultimately, like I said before, if you've got the right people around you driving a business forward, the growth you could achieve on the practice valuation, speaking to people like FDA, etc., you will probably be able to outgrow that increase in tax, if that makes sense. So it's not all bad, because again, it's not coming straight away. It's not straight away 18% it's gone up to. This is in 2 years' time, so there is time to plan. And that's always an underlying message I have whenever you're looking at taxes. It's all very well listening to me talk this evening and maybe putting a few things in place tonight, or thinking about a few things. Ultimately, selling your practice, looking at retirement, looking at the next stage of your life, whatever that is, business-wise, investment-wise, planning is key. Surrounding yourself with people, giving us advice, coming up with plans to actually try to mitigate tax where possible, or grow your business, all of this sort of stuff. You need to be thinking long-term. You shouldn't be thinking overnight. And this is why budgets shouldn't really be scaring serious investors, people thinking seriously of buying practices, because this is already kind of baked in, factored into their decision making, knowing this sort of stuff can come along, because they planned for it, they planned for these eventualities. So 18% in 2 years' time, there's still time to grow ahead of that. And even when it does kick in, you're still looking at 18% tax rate on, potentially, if you're looking at it from a retirement perspective, on your retirement, that's a pretty low tax rate still in the grand scheme of things. If you look globally, if you look historically in this country, and again, if you come back to the kind of the masterclass of Spin of what they've done, that it could have been a lot worse. If this was abolished entirely, you'd be looking at this rate of 24% noted above for the higher rate. So actually 18% is still a good rate, relatively speaking. And like I said, there's still time to plan around that, either try to get a sale in before then, if that's really on the cards, or try and grow and get your practice into the position where actually these increases don't really make a huge effect in real terms. And then a few more announcements. Now, these are a bit more general, less specific to the dental sector, but I will going to run through them because there are bits which will affect people. So inheritance tax, nil rate ban frozen at £325,000 until 2030. Sound like a broken record now. It's this actually stability, things staying the same is good news. Things can't always keep going down. At some point, they're going to go back up to trade revenues. So in the context of this budget, things staying the same is good news. At £325,000, that's the, for those who don't know, the nil rate band is essentially your inheritance tax personal allowance. That's what you can pass on your estate. That's a bit of an oversimplification, but that's what you can pass on your estate without paying any inheritance tax. So the fact that that's not been slashed to try and bring more people into the inheritance tax capture area, shall we say, is good news. Ultimately, inheritance tax is something that's been touted. Again, lots of headlines that they're going to go after this, try and bring more people, because only around about 6% of estates pay it. So that slashing that would have been a fairly easy move, but they've kept it where it is, which is good. But on the flip side of that, a little bit of taking that they're doing is from 2027, inherited pensions will fall within the scope of inheritance tax. There will be a bit more detail about that, obviously, closer to the time and the more we move forward. A bit of thinking, a bit of planning could come into play there, but ultimately it's going to mean that pensions aren't passing inheritance tax-free anymore from 2027. So it's still a few years away, but things to consider, have discussions with, particularly with financial advisors like Adam to discuss how this is going to impact you and impact your estate. Third point on there, business property relief reforms from April 2026. Not a huge amount to talk about here. The second paragraph really captures it. Really, it's looking at AIM shares, so alternative investment markets. Before, they'd be inheritance tax-free, covered by BPR, but now anything over £1 million, the first £1 million is still inheritance tax-free, but anything over £1 million is going to pay an effective rate of 20%, getting a 50% of relief, like it says on the screen there, on a 40% inheritance tax. It works out as an effective rate. Any AIM shares inherited over £1 million. The big, again, I said the big headline here, this was about farming really. I'm not including it on this slide, but that's the big inheritance tax change, that farms are being caught by the same mechanisms. But those of you who do invest in AIM shares, we just have to bear this in mind. It's an ever more popular market for people to be investing in. So if you do have significant investments in there, again, planning will be key for this. Talked about dentists liking to be landlords and liking to have property portfolios, could be affected by this. The higher rate of stamp duty for additional dwellings increased from 3% up to 5%, again with immediate effect. This has got a lot of headlines this morning in the news because some residential property deals have fallen through because people are having to find literally thousands of pounds overnight where this has gone up. For most dentists, I don't expect this to really be too much of an issue. Again, it's all baked into prices and the market reacts accordingly, rents react accordingly, etc. But again, it's just worth thinking about. If you do have large portfolios or you're intending to acquire large portfolios of residential property for rental purposes, if you're looking at additional properties here, so second homes and rental properties, it's really worth considering whether you should be using limited companies as a vehicle or whether you should be having those in your personal name. Again, factoring that into your whole plan, your whole inheritance tax planning. All of this needs to be considered as usual. So it's not other than the few people it affects, you suddenly have to find this additional money overnight. For most people, this is all factored in. Having these large portfolios, it comes with these increased upfront costs like stamp duty, and yes, that eats into margins a little bit, but again, it's not hugely horrific news. It's just slightly more inconvenient, shall we say. And then domicile changes. So this is to do with residency and the non-dom rules. They are changing from April 2026. I'm not going to go into a huge amount of detail there because it will be phased in, and there'll be various ways in which this is now assessed on a sort of residency test basis. If you are non-domicile, if you are non-resident, and you have a dental practice in this country and you're selling, etc., you'll be having these conversations anyway with your accountant to make sure that you're planning correctly around this to see how it affects you. But just be aware, if you were planning on leaving the UK but still having interest in a dental practice over here, that's something to be aware of from April 2026. So again, there is some room to manoeuvre. And the last couple of points here, so personal tax thresholds to increase with inflation. So personal tax thresholds, main one really is your personal allowance of £12,500. That has been frozen for some time, and it is frozen for a few more years. But from 28, 29 onwards, that's going to be increased. So that's a little bit of giving from the Chancellor in this respect. You hear terms like fiscal drag, where these rates are frozen, but actually inflation causes everything else to increase. It means that a higher percent of your income is being taxed. So those increasing from 28, 29 will be good in real terms for those still entitled to a personal allowance. Obviously, our dental practice owners aren't, but those of you who will have your affairs structured in such a way that you are able to claim your personal allowance, that'll be some good news. And then the final one, VAT on private school fees. I mean, the cat was truly out of the bag on this some time ago. This has all been confirmed for weeks and weeks and weeks, and this was just given the rubber stamp yesterday that yes, VAT will now be charged on private school fees. My word of warning, you can't really plan against this. It is what it is. My word of warning will be there'll be lots of get rich quick schemes out there, tax avoidance schemes that will find clever ways, or they'll purport to find clever ways around some of these rules, particularly the VAT on private school fees. I would always say approach with caution. When a budget comes out and it's fairly transformative, I mean, I say this transformative, this one hasn't had the wholesale changes we're expecting, but when they do introduce some measures like this, which are reasonably large and effective, there will always be people looking to make money out of that. So if you do come across any schemes which claim that you'll be able to reclaim the VAT on school fees using convoluted methods and offshore trusts and all this sort of thing, if it sounds too good to be true, it quite possibly is. So do approach anything like that with caution. Otherwise, it is what it is, unfortunately, for those of you paying private school fees. So what's the future hold? What's this budget mean for the future? Like I've kind of been saying the whole way throughout, this isn't all bad news. I think it's a great time at the moment for buyers and sellers. I think when you're selling a practice, these capital gains rates, these corporate tax rates being froze, this is all pretty good news. Yes, there's some small increases in there, but they're nowhere near as bad as they potentially could have been. Or, like I've said on the slide here, could be in the future tax rises. Rachel Reeves hasn't ruled out future tax rises. So the expectation is that over the next 5 to 10 years, taxes probably will still rise. So if you are looking at selling at the moment, you're potentially still going to be selling when tax rates are as low as they could be for some time. Likewise, if you're on the buyer side and you're looking at buying a practice, but actually you're thinking, I'm going to hold this practice for 10, 15, 20 years. I don't know what the tax rate's going to be in 20 years' time. Who knows what's going to happen in 20 years' time? So it doesn't really affect you. It's a good time for growth. The government's still investing in business. Corporate tax rates haven't been attacked. AIA is still available. There is still lots of potential for growth within the dental market, as we see year on year and year. We've had lots of statistics, and every year profits are going up for dental practices. So it's a good time for buyers and sellers alike, I think, at the moment. There is this perfect harmony of sellers are getting a great deal of planning available to them to be able to plan an effective strategy and get money out of their business in a tax efficient way, provided they're taking the correct advice. And likewise, provided buyers are buying things in the right vehicle, planning in the correct way, then I saw there's lots of potential there still for growth, etc. So kind of the future, the summary, yes, taxes might still go up. We've got a few of them already confirmed, but they are fairly incremental. So I don't think this is going to be putting anybody off. I think on the whole, this budget is, I'm not going to sort of give a personal opinion or anything, but actually from a strictly mathematical point of view, this isn't that bad. I think we were expecting a lot worse. I think this actually turned out to be fairly even, fairly balanced, with the exception of the employers NI, which will hit dental practices a little bit, but it's not going to change the game completely on that. It's not like, as I said, it's not like dental practices rely on 40, 50, 60 employees, so it shouldn't affect them the same way it will for some other larger businesses, and hopefully some of the increases in the allowances will help. But that's my bit now. I'm going to hand over to Adam to talk about more the financial advice side of things. I will just put my email address up on the screen again. If you do have any questions you don't want to ask in the Q&A, I'm more than happy to field questions by email on this topic specifically, or anything else involving compliance, planning, and tax efficient exits or acquisitions. So yeah, thank you for listening, and I will now hand over to Adam.
Thank you very much, Seb. That was very interesting, and obviously insightful in terms of how that can affect the business planning side. Not an area, of course, of my expertise, and certainly one, as Seb has said, if you're interested or thinking about selling your business in the next few years, or imminently, if you are trying to shoehorn planning in now that some of the rates have gone up, then speak to FTA, speak to Seb. I'm going to share my screen now. I'll focus. I've got some obviously shared information on my slides because the budget was the budget. But what I'll try and focus on with mine is what you can look at doing now and in the future to account for these with your financial planning. So if I bring this up. A little introduction about us. I mean, I've done quite a few webinars for the FTA group. I'm sure some of you here tonight will have seen me, whether it be talking about the NHS pension, as I've done about 10 in the last 2 years on the NHS pension, or general financial planning. We are the FTA group financial planning firm, and I'm the managing director here. We're specialist advisors to medical professionals, dentists largely, but pharmacists, doctors. I actually deal with all sorts of clients, not just medical professionals, but it does help for yourselves here tonight, knowing that we do know about your industry and the financial planning that goes with it. We're independent whole of market advisors, and I've listed a range of services that we cover below. If you don't work with a financial advisor, then this might be of interest to refer to. If you work with a financial advisor, I'm sure it's quite similar. Crucially, we're NHS pension specialists, so I'm helping a lot of new clients in the last year or two who need assistance with their NHS pension more than ever because of the McLeod judgment. Now, I won't talk about that tonight because I must have racked up about 15 hours of webinar time in the last year alone talking about it. If you want to talk about that, contact me and I'll put my contact details at the end. So, as I say, information on screen. I'm not going to go back through the changes word for word as it's sort of repeating what Seb's already covered. But what I'd like to focus on in what this means for your financial planning. And I've picked out some key areas, and then I've talked a little bit at the end. I'll talk a little bit at the end about, other things to think about to grow your wealth, because a general overview, as Seb has said, is that this budget has predictably increase some taxes in key areas, but with some planning and foresight, you will be able to account for these. And the economy in the world is still recovering. The markets, financial markets, which I'll talk about at the end for investments and pensions, are very buoyant. They've been extremely strong in the last few years overall, but certainly in the last year especially. So there's always going to be a way to account, and there will be some people caught out by these tax changes. As Seb said, they're just going through a transaction. Oh no, it's changed. But largely there's capacity to actually forward plan. So in terms of capital gains tax, I've had a lot of clients who have investment properties. Most of our clients have investments. They have properties, diversifying, but lots of properties who are concerned. I was looking to wait until my tenant ran their contract up by next year and then looking at selling. But what if they align capital gains tax to income tax rates? Well, actually, for residential property, which is what a lot of people are concerned about from my point of view, where you don't have the same flexibility in timing a sale always, that hasn't changed. The capital gains tax hasn't changed, but it has changed for people with shares or funds which aren't sheltered in an ISA or a pension like some of our clients do. And capital gains tax has gone up The tax-free capital gain allowance, the annual exempt allowance, as the government call it, remains at £3,000 per person. If you can remember, that used to be a lot higher. It used to be over £12,000 only a few years ago. So there's not that much room for realising gains within the tax-free allowance, but there is some room there. And crucially for capital gains tax planning, they haven't changed anything in regard to loss reliefs, carrying forward losses from previous years. Our investors who've invested in funds and shares might have had gains, substantial gains this year, but perhaps losses in 2022 that they realised as they move shares out to fund their ISAs or their pensions. And they can still be carried forward. So there's opportunities there to offset, but the taxes have gone up, and this will affect your decision in terms of which investments to set up, especially when you sell a business and you have a large sum of money and you can't add it all into a pension or an ISA because they're the best investments because of their tax efficiencies. That said, even with these increases, the 18% rate especially is very attractive compared to most tax rates on gains from investments. If you think, for example, you got money in the bank, if you're a high rate taxpayer, you're paying 40 or 45% tax on the interest that you get. So 18% is still a very attractive rate for investors, albeit it's gone up a bit. In terms of planning for this one, very little you can do now because they've brought the rate in with immediate effect. But as I say, it doesn't quash the benefit of investments which are subject to those. Just a quick note, and something I was speaking to Seb about before the call, which he did touch on about the business disposable relief. A lot of you may be have been planning a retirement or a business sale in the next couple of years, and this is, on first glance, coming as a bit of a blow. If you sold it now, the first $1 million is subject to 10% capital gains tax, and if you sold after April 2026, which is only a year and a half away, and to be honest, if you wanted to sell by then, you're getting it on the market within the next 6 to 9 months anyway, it's going to go up to 18, so an 80% increase. Now this seems awful on first glance, but as Seb said, it isn't all as bad, and I've crunched some numbers, and actually on these rates you'd only have to grow your business by business value by 10% to completely offset this tax rise. Now, easier said than done, but obviously there are methods which FTA can help with to prepare for business sale and actually improve the value of the business. Obviously, with interest rates hopefully falling next year, they have been very slow to fall. They've only dropped down a little bit, but as they come down, that might boost that value in the market as well, and offset a large amount of this. So this isn't a call to action in terms of selling now because the rates are going up. There's likely to be reasons why the value could go up and actually offset those for various reasons, with a bit of input from yourselves with your businesses as well. The huge one for me as a financial planner was pension allowances. I've had 150, 200 calls from clients or new clients in the last few months, worrying, will my tax-free allowance, tax-free lump sum allowance be affected? What about my annual allowances? Should I put a pension contribution in now? Should I wait? It's been quite tricky to plan. Now, I've been very keen to reassure people, not that I know exactly what the budget will entail, but it didn't make any sense for them to muck around with pension allowances, aside from what I'll cover in a minute, which is the inheritance tax on personal pensions. It didn't make any sense to muck around with these too much at this stage. What they're petrified of doing, the government, are changing pension allowances, which then mean that senior workers in the NHS, teachers, public sector will leave positions early. And that's exactly what happened a few years ago when they changed what's called tapering allowances, where you earn too much money, your allowances go down, and people start retiring from the NHS. So I didn't expect they'd change anything. Not that I knew 100%, but they haven't. So all these allowances still remain. You can still put 60 grand a year into pensions and get huge amounts of tax relief. If you haven't done any pension planning, or you're not really on top of working out how to maximize this, it's enormously beneficial because you get marginal rates of tax relief on contributions. You can add in from your limited company and get corporation tax relief, and then future, of course, capital gains tax relief, because you're not paying that because it's in your pension. So something to look into. You've got carry forward allowances still available. I thought this may potentially be tweaked, but it hasn't, so that's good. Tax relief on contributions stay the same. Everyone was saying, oh, they're going to bring in a flat rate tax relief on contributions. That would have been mental, in my opinion. It just actually overcomplicates it because of the different rates you get for net pay arrangements with employer schemes and all that sort of thing. They haven't mucked around with it. It's been the same for a very long time, and they're going to keep that the same. A common question was, and a lot of you here will be adding to personal pensions from your limited company, as you probably should, if you have capital available and allowances available, and running employer pension schemes. Of course, nearly everyone here tonight will do so, and perhaps doing salary sacrifice arrangements, which most employers should at least look at. I'm sure Seb can help with this type of thing with calculations, as can I sort of guide on it a little bit, where you pay a higher employer contribution to your employee's pension, and everybody saves national insurance. You do as an employer and they do as an employee, so everyone's a winner. I thought they might tweak this. It might be an easy one for them to tweak, because actually salary sacrifice arrangements are orchestrating the rules to sort of benefit employer and employee, and it might have been an easy one for them to say, oh, by the way, there's NICs on employer contributions, but they haven't done that. They've obviously increased employer national insurance on salaries, but not on pensions. No notification of that. So still add freely from your companies and do your salary sacrifice arrangements for your employees. There is still no lifetime allowance on pension savings. Of course, this was well documented to have been removed by the previous government, officially from April this year, but actually announced a year previously. And then this was replaced by the new lump sum and lump sum death benefit allowances. So everything is as it was, which is great for me because and for you, because it allows you to keep adding to pensions, keep getting tax relief while you're working, and pensions remain absolutely priority number one in terms of maximizing your wealth for retirement. In terms of other things that have changed or not changed, Seb's alluded to this. No changes announced to income tax, national insurance on employees. Obviously, on employers it's changed, but on employees it's not changed. Corporation tax and VAT. Corporation tax, I think really the official line was we're going to cap corporation tax at 25%. Now, at the moment, we've got a tiered rate. Watch this space to see if they do in fact tweak that tier, or actually just freeze those tiers so that as profits go up, you get dragged into higher rates. I don't expect they'll muck around with it too much imminently now they've done this budget, but watch this space on that. I won't cover employer NICs. Seb, you comfortably covered everything I would ever imagine talking about there, so we'll breeze through that section. Inheritance tax relief. Well, as Seb said, very much a psychological presentation in terms of spinning the budget in the build-up and then in the actual budget itself in terms of inheritance tax relief, starting with we're committed to freezing inheritance tax thresholds. That's great, and they've actually extended the dates on those up to 2030. So brilliant. We know what we're dealing with for an extra couple of years on top of what the previous government said. But they have reduced some crucial inheritance tax reliefs. It's not going to affect the country largely. It's actually going to affect, like much of this budget, business owners more than not. So business property relief, AIM share relief, cut in half. Business property relief, the first million is as it was, 100% relief, and then reduction. Not really much you can do and plan for with these. There are other methods of planning for inheritance tax, of course, trust planning and other investment planning. And you should work on a gifting plan as you get older with your family and with a financial planner. But a lot of the changes they are what they are. Now, the pension rule, I fully expected, and I told all our clients that since the lifetime allowance was removed, pensions are too generous. There was absolutely no cap on how much you could have in pensions. You could have all these tax relief saving. And actually, a lot of our clients would then say, well, I've got other money I can use in retirement. I'll just leave that £1 million or £500,000 or whatever onto my family, inheritance tax free. And whilst if you die after age 75, you leave a pension pot if it's an invested pension, a drawdown pension or a defined contribution pension. And then your beneficiaries pay income tax in future when they take it out. That's kicking it down the road 40 years for some people. So no government, especially one in deficit, wants to kick the tax down the road 40 years. Well, maybe the previous government did. I'm sure they'd have remedied this at some point if they'd have stayed in. So what's been announced is that from 2027, pensions will be part of a deceased estate within the inheritance tax regime. They haven't said that they're going to charge 40%. They haven't said how it's going to work. Now, previously, 12 years ago, before pension freedoms and flexibilities came in, and they actually reduced the lifetime allowance, but made pensions a lot better in terms of the flexibility of taking them. There was a drawdown tax if you left a pension pot, an invested pension pot to your family. And I think they're probably going to do something similar, because if you imagine you're going to leave a £500,000 pension onto 3 children, it's going to be split equally. Well, how does that work? And then do they inherit a pension and pay income tax, or does it just get paid to them net? Do they have a choice like they used to? I think they're going to probably bring in a flat rate tax on, if you leave a pension pot on death, we'll take 25% of it, for example, and then it remains in a pension, and someone then takes money out and pays income tax, and that might add up to more like the 40% inheritance tax. We don't know yet, and they're actually going to have consultations, and they say announce in 2025. So keep your eyes peeled. Now, you might think, well, is that a problem for saving into pension? Not at all. There's still going to be, it's still enormously beneficial. Saving into a pension. What it does mean is that some people might then plan to take more income out of their pension than they might have ordinarily done. Sort of a lot of people in the country, and this is what Labour are looking at it as, is that they save into a pension, they then need that pension for retirement. I'm sure a lot of you here tonight, and a lot of our clients, not all but a lot, are wealthy enough that they can save into a pension and actually choose if they use that pension or this property or this cash account or this ISA or whatever to fund their expenditure. And as such, you know, a lot of our planning for clients in the last few years has been, well, you don't need to take tax out your pension, pay 20% or 40% income tax, and then have it in your estate subject to inheritance tax if you die, because that pension can be left inheritance tax free. Why don't you use this investment or that instead? Not always blanketed like that, but that's been a general sort of side of the planning with those reliefs. And it will move more towards taking your pension income, and that's what the government want to get to. You get all these benefits saving into a pension, but then you largely use your pension for retirement. Now, if you imagine you're adding money in now, as a 40% taxpayer, and taking it out in retirement as a 40% taxpayer, you think, well, what's the point? Well, because you get a tax-free lump sum, and because there's other tax breaks in a pension, just by putting it in now and taking it out in retirement, you get a 41% uplift on your money. That's excluding any investment growth you get. So it's still enormously beneficial saving into a pension. It might then just change your use of the pension in retirement. You might take a little bit more out as income, but that is how it was up until sort of 10, 12 years ago anyway. Notable changes here. Seb, you've covered this, I think, sufficiently. So with my final couple of minutes, because I'm going to stop in 2 minutes and give a chance for Q&As, I just wanted to allude to things to think about with your financial planning. Are pensions, as it's been for the last few years, especially now, if you've got a business, you've got money in the business, get money into a pension, it gives you corporation tax relief now, or personal tax relief if you've got a sole trader. It then saves you money on the business sale if you're a limited company as well. You've got to look at optimizing pensions while these rules stay very, very generous. Have you reviewed your NHS pension? Absolutely crucial for your retirement planning. And preparing for retirement. So aligned with, when should I sell my business? Well, have you done your financial planning, pension planning, and other retirement income planning? And pensions would be the start of that. Savings and investments, there's still lots of ways that you can grow your money tax efficiently. You know, ISAs are a good way. Pensions first, and then ISAs. There's other investments which give substantial tax reliefs as well, like venture capital trusts, if you're a slightly higher risk investor for some of your money, and something we can help with. And looking at whether your partner is saved too. If you're in a marriage where you've got business, maybe not all split 50-50, it's about looking at opportunities for both of you, because there might be allowances that are better used by one of you or the other. And the optimal arrangement is having reasonably equal, not that any of our clients have exactly the same, but reasonably equal holdings in retirement because of the individual tax rules. And tax planning, which Seb has covered a lot on today in terms of what to look for in this budget and how that affects you. You know, are you using your reliefs? Are you preparing your business sale to limit capital gains tax? Well, that might be selling quickly if you're thinking of selling anyway to limit tax. It might be not selling quickly because your value is going to go up, but actually doing some pension planning or using some other allowances in the meantime. And inheritance tax planning is always crucial, but it's even more crucial now the rules have changed. And I just want to touch very quickly on at the end with my last minute. I'm sure a lot of you here tonight invest, and the markets have been very, very strong over the last few years. You're looking here at an example of a sort of slightly higher risk, a medium and a slightly lower risk portfolio performance. And the last year, the markets have got firmly back on track with the economic recoveries that we've seen, and inflation coming down across the world. So lots of opportunities still to work with me or your financial advisor to grow your wealth and keep it tax efficient. Obviously, happy to field any questions now, and if it's not covered, contact me and we can have a consultation, a chat on the phone or a Zoom meeting and discuss your personal situation. And I've talked for well long enough, and I want to give a good 10 minutes for Q&A, so I'm going to stop my share and invite back in you, Seb, and Andy and Chris to take us through some questions.
Thanks, chaps. That was brilliant. Really, really enjoyable. And what's nice is we all get to listen to the Chancellor, we all get to see the headlines on the news, but getting the kind of the detail, the clarity around what it is that it means for small business owners, and particularly dental practice owners, is really, really useful and insightful. I think the thing that stood out for me that I thought was a really cool line, I'd not heard it before, is one that Seb said, which is outgrow tax increases. And I love that because, we quite often in life, we worry about things we can't control, and that's tax. Yet what we can control are our own businesses and how we behave and how we perform. And that's not to just diss taxes and say, don't worry about them. Of course, they're there. We have to pay them. We want to manage it as well as possible. But that mindset of kind of outgrowing it, when you decide to exit from your business, whenever that might be, if your business performs well, the increase in taxes we see in this budget hopefully won't be so painful. So I thought that was really cool. We've had a few questions come in, so if we grab those to kick off with. There's a couple that have come in related. So do we think this would increase values or decrease them? And then kind of related to that, what kind of multiples can we expect on NHS goodwill, the private recurrent versus private fee product?
How long's a piece of string?
I was going to say, go on, you can grab those, Chris.
How long's a piece of string? Me.
You're sat in the crystal ball, Andy. You should answer.
Yeah. I think it's that classic one, isn't it? Do you know when we do the seminars for buyers, and they say to us, "So why are practices so expensive?" And we say, "Because you buy them. If you stop buying them, then the values would drop." And I think it will be. I think it would depend on the demand of the buyer, basically, and the bank's support. And that will then dictate the values. I mean, the value may well change on multiple if the profits have come down, but then going back to, as you just said, Andy and Seb said, if effectively your pace of profit growth outdoes the taxation growth, and it's not the CGT growth, it's things like the national insurance. How is it going to affect you and affect your bottom line? But it's a bit like, isn't it? Do you remember that conversation we had so many times when people in probably 22 and 23 were high utility bills and all their team wanted extra money? And we were saying, yeah, but when you actually look at it in isolation, the actual extra cost that you're going to incur against what you would actually have to generate to cover that is nowhere near as significant as you might think it is. But you need to understand your numbers. So I think it's how long's a piece of string. And I think it will depend really on what happens on profitability. And as Seb said, a lot of the smaller practices, it probably won't have a huge impact upon them. There'll be some impact, but we wait and see what that will look like, really.
I would imagine, not that I'm an expert, Chris, but what we've seen in some of the investments that we run is the uncertainty that we've had in the last 3-4 months has actually caused an issue with potential, appetite to just freely spend the money on a business, whatever it may be. And actually, probably short term after this budget, with the running theme being, okay, taxes have gone up, but it's not all these mad things that were doused to us by the paper in the last few months. It could actually have a short term positive effect on the markets, I imagine.
Demand is there. I mean, it's interesting. There's no doubt about it. Demand has been strong since definitely the back end of last year. Banks are supportive. People are paying decent prices for practices. And I think the other, when you look at the CGT thing, as Seb says, and you said, it's actually not that bad.
Yeah.
If it was at 55% or 45%, then you could see people thinking, "Oh, that's quite a lot of money." But
I also think that the paralysis has happened. I think people were bricking it that this was going to be a terrible, terrible budget. And I think the media noise and the run up to this, about a month to 8 weeks, about 6 to 8 weeks before the budget, there was so much noise and rhetoric. I think that was the paralysis period. So my view is, I think now people are going to see this and they're going to groan because taxes have gone up. It's never going to be a good day. But it wasn't as bad as we thought. And also budgets kind of keep coming. So it's not like it's going to change. And we all know broadly what COVID costs. So the money has to come back at some point. So I think over time, taxes generally only go in one direction.
Wasn't income tax put in the Napoleonic Wars as a temporary tax to fund them? And that's about 200 years ago. And I seem to remember, some of us who are old enough remember VAT when it just temporarily went up a bit.
No, I think you're quite right. I think taxes are inevitably probably going to go one way, and it's, instead of being in one hit like I think we were sort of led to believe, they are taking this softly approach, which is better because it allows the markets to adjust. It allows people to acclimatise to a new normal, as opposed to having one massive wholesale jump, which scares everyone half to death, which is what the mini budget was a few years ago. So I think lessons have been learned. I think it's really just the markets waiting and seeing. I think you've hit the nail on the head there, that paralysis period. We've seen that in all elements of planning, where we've said, actually, if you're thinking of incorporating, if you're thinking of doing some significant planning, selling, etc., wait a month or so, ignore the media for a little bit, wait a month, let's see what actually happens. And even in the last 24 hours, all the feedback I have is, let's just press ahead as before, because there's nothing which has materially changed our opinion of what's going on. And that's the key. It's kind of almost business as usual still, with just being prepared to pay a little bit more out of your pocket here and there. But on the whole, it's nothing I would say to worry about. I think it's good practices will still sell. That's the bottom line. I always say, if you've got a good quality, it's not just practice, business of all sorts. If you've got a good quality practice that you've prepared for sale, that will still sell. That will still keep the value. If you've got a practice which you haven't prepared for sale, you haven't got the right advice, and you haven't prepared properly, then yeah, you may struggle, but you would have struggled anyway before, maybe. So it's about getting that legwork in, getting the right people on board to get it ready, and yeah, ultimately that will still hold the value, regardless of what happens in budgets, because it's all relative. People still want to buy.
Seb, when you were talking, you talked about some changes to domicile.
Yes.
And there's a question that's coming. He says, can we set up a limited company in a foreign country like Ireland or Cyprus before setting up, where tax laws are more lax?
I mean, no very quick answer to that, other than realistically no. Ultimately, anything you can think of, where you go, so well, that country's got lower tax than over here, why don't I just put a company in that country? There are lots and lots of rules to capture anything like that. Ultimately, if you're trading in the UK, having a UK company to set up is the most efficient. You could set up with a company in another country, but you're going to be caught by UK tax laws anyway, and have to pay huge amounts of professional fees to fill out the stack of paperwork to go along with it as well, and ultimately save no money and pay a lot more at the end. So no, again,
No.
goes back. Yeah, I mean, I'd love to say there's a magic wand. All of this stuff, there's no magic wands at the end of the day. HMRC, and for all the discredit the government gets, they are reasonably clever sometimes, and they have thought of some of these things as well. So there's always usually something to stop you doing something that's too obvious. And yeah, setting up abroad, unfortunately, just won't wash. Sorry, apologies.
Lovely.
I couldn't give you good news on that one.
No, it's good to get the clear advice. Good to get the clear advice.
I'll have to close that company in Rwanda, Andrew.
Yes. One coming in your direction, Adam. What are the options to avoid and minimise IHT on pensions?
What are the options to avoid IHT on pensions?
Yeah.
Well, using the pension, well, we don't know what the form's going to be, as I say, but and what it'll end up being is, I imagine, a trade-off. And if you're a 20% taxpayer, income taxpayer on taking income out your pension, it will probably work out marginally better to take the pension income out, pay a bit of tax, and spend it, than leaving it in the pension. And that's not the case at the moment. Well, it wasn't until well, it is at the moment, but when they bring it in 2027. But I still think, if you're a 40% taxpayer, it's not going to be a case where you need to drag all your money out your pension and pay 40% tax, then the money's in your estate. What can you do to offset that? Well, planning accordingly your income plan, but it's not going to negate the benefit of having a pension and leaving it on. It's obviously a change, and it's a change I fully expected. Once the lifetime allowance was removed, they're going to bring in some sort of death benefit tax charge. You can't really be aggrieved at that based on the generosities of adding money in, I don't think. But what can you do? Well, they've also announced, I didn't cover it in my slide, very similar to the last question, can you move it offshore? Well, you can move your pension offshore. And previously, there was sort of a couple of options where you didn't have to pay a 25% overseas transfer charge, it's called, of your pension fund. There was a few options like Gibraltar and a couple of other countries. They've announced in the budget that that's been removed, and all these countries have an overseas transfer charge. So basically, not a lot, unless you've got about 3 million in a pension and you're thinking of moving abroad anyway. Or if you're thinking of moving abroad anyway, it might be worth looking at an overseas transfer. But there's not much you can do apart from plan accordingly with your income. And that's what we'll work with our clients on now. Clients who may have previously not, been taken, I don't want to pay tax on that. Well, should we take 20 grand a year or 30 grand a year out your pension? If you don't need it, let's put it in your ISA. Let's get that growing tax efficiently. But actually, you're reducing that potential inheritance tax later. We just don't know the rules yet. So you've got to wait till the rules are out next year to really plan properly.
Cool. Lovely. Cheers, Adam. One more, probably for you, Seb. As a private practice, does the business rates relief apply, or do we pay the full whack?
I'll be honest in saying that there was a little bit of detail on that yesterday, but knowing the actual ins and outs of that, I haven't had a chance to look at in full yet. But ultimately, you paid it before, you're probably going to continue paying it. It's only really NHS practices that can get away with getting a reimbursement for that. So yeah, without having looked at all the full detail, I know there was a small amount announced about it, but it wasn't this big giveaway that's hit headlines. It's going to affect lots and lots of businesses. So my suspicion is that it's probably not going to really change a huge amount on that. But again, just contact local authorities, see what relief are available. But my suspicion is that it will just still apply as before.
Cool, lovely. And then the last two, there's two questions around valuations. What EBITDA revenue do corporates start taking in interest? I'll take that one, and then I'll let Chris take the last one. So EBITDA revenue for corporates. Corporates ideally are looking for around about 800,000 to 1 million of revenue, something in that order. And the reason for that is a typical corporate is going to put through something like £100,000 of head office cost on a practice. So if it isn't a certain size, it's just not throwing off enough EBITDA and profit to make it actually worth it. What they're looking for as well, in addition to that, is growth potential as well. So they're not really just looking for a practice that's throwing off £1 million of revenue and that's where it stops. They're ideally looking for a practice that's perhaps got capacity for 4, 5, 6 surgeries. So they can perhaps add 50, 70, 100% to that business over the coming years. But that's kind of the number that they start at, around about £1 million revenue. So if that's a principal-led practice, that profitability probably looks somewhere around the £300,000 mark, something in that order. And then the last question, which I'll back Chris's way, is what sort of multiples are private practices going for at the moment?
Do you remember that piece of string that I had earlier on? I'm going to reintroduce it. It is so. It's not like a house, I think, is the answer. So it varies. It varies hugely from either, is it an owner-manager purchase or a multiple owner purchase? So that makes a change. And also whereabouts it is. That's the biggest change. You could take, let's say, a fully private practice, fee per item, and let's say you whacked it in Hertfordshire, which is a very, very popular area, and you could be looking at 5.5 times. You then move that down to Cornwall, where everyone wants to go on holiday, but not many people want to live. you will find that it might be down as low as 1 to 2 times. And also the reality of it is that, remember, that's EBITDA, whereas all brokers will effectively do something like, we call it reconstituted net profit, there might be fair maintainable trade, whatever it might be, but basically it's EBITDA on steroids, because we add back various things, and it's massively variable, you know, and things like, is it a specialist practice? If it's specialist, the multiple won't be as high because there's not as many people who can buy it. If it's got lots of plan income is more desirable than fee per item income. So there's so many contributing factors within it. It's really hard to tell you. We can sort of give you rough range, really, which I've done.
Yeah. And I think on that, if anybody specifically wants to know about their practice, give us a shout, and we'll look at your numbers and we'll let you know. We've just teetered over the 8 o'clock. Thank you, gents. That was great.
It was brilliant.
It was really nice. We had a lot of stuff to get through.
I'll tell you one thing, Adam. Can I just ask you a quick question?
Yeah.
You know that thing on VAT on private school fees?
Yeah.
You had something that said boarding. So is it only on boarders?
No, it's on everything. That's the
okay.
thing. It's on if it's the private school sort of term fees, if they do any courses
right
from a private school, basically anything a private school does touches is subject to VAT. But as Seb said, this isn't news. We've known this for a few years. It's been formally announced, but it's been
the only real news.
for many months. Yeah.
Does that mean it's only, you know, places like Eton and Harrow, and if you go to like your local private school?
Well, I've been asked by loads of people, what can you do? Well, not a lot. I mean, you know, there will be people who get in contact with you. Some people here tonight. Oh, we do this. There's these loopholes. Be very wary, as Seb said. Be very wary. We've seen, you know, in the past, you've got to be careful. There are legitimate ways to make your financial planning and tax planning that Seb and I can help you with. But these loopholes, if you do this and it moves here and then it comes back here, the government will pick up on it, and they can pick up on it retrospectively as well. So it is what it is. And obviously some of you are partway through with 3 kids, partway through, and you don't want to take them out. It's going to add on a big cost. It is what it is. It's not news, as I say. You've had a few months.
Sell a kidney.
Yeah, just on that front, the only thing I saw over the summer was people advertising if you prepay fees, this might be able to, you know, if you've only got 2 years left and you've got the cash in the bank. But I'm pretty sure if you look at the detail on it, I think anything from 29th of July onwards, or around basically when it was leaked, anything that time onwards. So anybody who shelled out 60 grand for the next 2 or 3 years to try and avoid it all, unfortunately, you're going to get VAT on that as well. So everything.
That's funny. And then, well, it's not funny, is it? You did the right thing at the time, because, you know, people who, for example, sold shares before the budget, like some of our clients did. Well, I'm not sure. Well, I'll tell you what, I'll sell a chunk. You know, I might pay a bit of tax, but I wanted to do it anyway. They're quids in because there's a cliff edge drop. But then some things they've gone, oh, by the way, anything from this state. So that's one way. You probably did the right thing at the time if you've done this, but actually in hindsight, it's made no difference.
Yeah. No, brilliant. I thought it was really good, guys. Thank you so much.
Really enjoyable.
And doing it at such short notice. That's brilliant. It's great. Thank you.
Yeah, it's really good. No, cheers, Seb. Cheers,
Thanks, everyone. Thanks for attending.
Cheers, guys. Have a good evening.
Cheerio.
Cheers.